We did. We actually have a really good episode for everybody tonight. So, welcome back to the show, everybody. Today, we're going to get into a commonly used phrase in the financial space known as EBITDA. And that's actually stands for earnings before interest, taxes, depreciation, and amortization. But while explaining this, we'll probably go over a lot of other key details.
Yeah, so let's jump right in. It is a financial metric that shows how much money a company makes before taking into account non-operational expenses like interest and like taxes. So on cash expenses and stuff like that, so depreciation and amortization, all the things we listed out. So depreciation, amortization,
Mm-hmm.
taxes, and interest.
Yeah. So I think before we dive into this, it's key to know, there's three main financial statements that a business has.
Oh, look at you getting financially savvy.
Oh, just a little bit. This is back. I'm dating myself a little bit. Shout out to Professor Norris.
Mm.
Yeah. But there's three main statements when reviewing a business that you would want to ask or you would want to look at, right? First is the balance sheet, right? As your assets, your liabilities, no secret there, what a company owns and what a company owes, right?
So let's give this a bit of a more, common feel. If you were to put together your balance sheet as an individual, you would list all of your assets and all of your liabilities.
What would some of those look like?
Right. So for most people, their asset is going to be their home. Their liability is going to be their mortgage.
And then your bank statements, like your cash that you have, would also go in on the asset side,
Yep.
right? And your credit card debt, right?
Go on the liability side.
Yep.
You take all the assets and add them together, and hopefully it's a bigger number than all of the liabilities when you add them together, and you subtract your assets from your liabilities, and that in and of itself gives you your net worth. Well, companies are really no different. Whenever we talk about a balance sheet for a company, we're talking about all the same things. It's just that they're more technical in what they have.
Yes, exactly. And then the next statement, which we'll be diving into today, it really is the income statement, right?
Mm-hmm.
Think of that as, the profit and losses of a company. You have your revenue, and then you minus all your expenses, and you figure out if you have any profit or what's their net income at the end of all that.
And for an individual, if you're a W-2 wage earner, your income is your W-2 wage job and any other source of income that you might have. For most of America, it's just your job.
Mm-hmm.
Then what you're going to do is you're going to subtract all of your expenses. Now, similarly, when you look at EBITDA, it's earnings before interest, taxes, depreciation, and amortization, right? So think about it in the context of your income. Your earnings before interest and taxes, right? That is your W-2 wage before you're taxed, your gross income.
Mm-hmm.
And a lot of reasons why that's important for you is whenever you go to qualify for a home, they're looking at your gross income.
Right. That's the front end ratio that we've spoken about before.
And in business, really what you're talking about, your earnings before interest, taxes, depreciation, and amortization is your true gross income.
Right. Exactly. And then that last statement, which we'll briefly dive into today, is the cash flow statement, right? It's basically the amount of cash a business has on hand and how they use that cash throughout that cycle. And keep in mind, for the balance sheet, for the income statement, and for the cash flow statement, these are always snapshots of a period of time that it's covering. It's not, since the start of the business. It's just at this given moment, the data on the statement, this is where they're at.
Yeah, and it's always subject to change. Obviously, you're going to have some interesting things from a tax perspective that I think is worth noting here. It is not uncommon in the business world to see tax returns that don't necessarily align with the income statement. Keep in mind that whenever you are reporting your income for tax purposes, there are tax implications to reporting income, and there are different ways that you do it for tax purposes, right? There are guidelines and rules. But you may have an income statement which looks very much different and in some cases more profitable because the income statement is really trying to capture this EBITDA or earnings before interest, taxes, depreciation, amortization, because it is a like way to compare business to business to get the true cash flow from operations. It's hyper useful for investors. It's hyper useful for anybody looking at the business to analyze its profitability because it gives you an idea of how profitable any company is.
And it allows you to compare it to other like-minded or other like businesses, right?
Yeah.
So you might begin to ask yourself, okay, well, why would we want to exclude it? Okay, the true cash. Why? Why would you exclude the interest, right? Because every company has different financing structures, right? Not everybody gets the same terms, right? The same interest rate, things of that nature. So you want to exclude that to get to the heart of the business. Why would you want to exclude the taxes, right? Certain companies that are headquartered at certain locations have pros or cons to where they live geographically, right? So that's another reason why you'd want to pull that out. And then depreciation and amortization. What is depreciation exactly?
So you have assets that you have on your balance sheet, which you can depreciate down, and you can use that depreciation in any given year to offset your tax liability.
Right. So it's like the wear and tear of that asset over time. You're
Mhm.
allowed to, you know, I guess devalue it over time because it is losing its value because it has an economic life, right?
Right, exactly. A useful economic life. Then when we get towards the end of it, there's no more depreciation left in it, which you'll often find businesses will then buy something new to depreciate. Right,
Right.
you can depreciate hardware and stuff that you have in your office for like tools and peripherals, computers, stuff like that. You can depreciate larger buildings. You can depreciate cars.
Right. That's a very common example. So if you were to go look this up, a common example that you might come across is if a company buys a truck and it's worth costs $100,000
Mhm.
over the course of the next 5 years, you can depreciate that asset $20,000 a year.
Yeah, because you're depreciating it down, and that's why it is a quote depreciating asset. Right, it's not something that's going up in value; it's going down in value over time.
Right.
So, more, I guess, simply put, what I like to tell people when they start looking at earnings before interest, taxes, depreciation, amortization, and this phrase EBITDA, which is so widely used in the business world, is that you're really talking about net income, right? Everything else, you have interest expense, you've got taxes, depreciation, amortization. These are things that aren't necessarily real income implications. And let me explain this to you. So, whenever you're making money, your net income, this is how much money you're making from your operations. Your interest expense, right, is not really something that's coming out of your earnings every single day in operational sense. This is more of a tax and accounting expense to you in how you account for it on your tax return. Your taxes, your taxes are going to come out, but your taxes aren't necessarily done instantly. When you're running a business, you can pay quarterly taxes, you can pay annual taxes. There's different tax structures that are in place. So again, it's not going to give you a true indication of your cash flow on a quarterly and annual basis. You're looking at that after this was paid at a certain snapshot in time, to your point earlier. Depreciation is a tax accounting methodology. It's not real. You're not going to actually lose money because your vehicle is depreciating down. You still have the vehicle, you're still using it. So just because it's losing value over time doesn't impact you. Very similar to a consumer. If you were driving a car and you bought it for $50,000 and it's now worth $20,000, if the car's still running fine, your utilities using it. Same for businesses, right?
Mm-hmm.
Amortization, you're amortizing the cost of things like interest over time, right? And your amortization, like on a mortgage for you, whenever you depreciate it, is effectively a write down for tax purposes.
Right.
Companies, same thing. So really, you're talking true operational expenses minus the things that, for tax reporting purposes, in large part, almost entirely, are fabricated numbers or numbers that come up on either a quarterly or annual, less consistent basis. If that makes sense.
Right. So, and if you're wondering, why are we talking about this? This is a key term that's commonly thrown around when you're trying to evaluate a company's operating performance.
Mm-hmm.
Now, it's not lost on us before we start getting attacked in the comments, right, or in the DMs that are RIP to the legend Charlie Munger, that he called this the bullshit earnings, right?
I did not know that. Is that real?
Yeah, he called it bullshit because he's obviously he's very much aware, and we're aware too that there are an infinite number of ways to hide some of these recurring or non-recurring expenses to hide the true operating cost or value of a company. So that but that doesn't mean that you shouldn't know what this is and what this means. I mean, this is a good starting point, right? Because if you were to just solely use EBITDA to value a company based off a multiple, I mean, it's way more complex than that.
Yeah, it is. But again, EBITDA is like one of those ubiquitous things that we use industry wide to evaluate businesses. It is commonly understood. I understand that someone like Charlie Munger has a more technical perspective on this. But for most people who are listening to it, just getting a simple grasp of this as an indicator, it's valuable.
No, it's absolutely valuable. You need to know it as a starting point, right? As a launching pad. Yeah.